Hi everyone, today we'll be going over accounts, May June 2020, paper 3, question number 5. This is structure paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours, so we will be attempting to solve each question under 30 minutes. And this question number 5 is a part of section B, which deals with cost and management accounting. So without any further delay, let's get started. Tea Limited had the following standard costs and budgeted information for the month of August. Okay, we are given the direct materials and the kilos per unit required is 5 and the cost per kilo is $4. So the total direct materials per unit is just going to be the kilos per unit times the cost per kilo. So that's going to be 5 times $4, which gives our direct materials per unit to be 20. Then we're also given the direct labor. Hours per unit is 3 and the rate per hour is 12. Again, the direct labor per unit would be hours per unit times the rate per hour, which in this case will be 3 times $12, which gives the total direct labor per unit to be 36. Alright, then we're given budgeted output and sales. We are producing 4,000 units and selling those 4,000 units. We're given budgeted direct labor hour, which is 12,000. We're given budgeted fixed overheads, which is 42,000. And the expected unit selling price, which is 82. Then we're also given the information that Tea Limited uses absorption costing. The overhead absorption rate is based on direct labor hours. And for the first part of this question, we need to calculate the total budgeted profit for August. Alright, so in order to figure out the budgeted profit, we can just subtract the per unit cost, which we just figured out for direct materials and direct labor, from the selling price, which is again per unit, right? And then multiply it with the total number of units, which is 4,000. And then we can subtract our budgeted fixed overheads in order to receive our total budgeted profit. Okay, let's do that. We have our total budgeted profit. And we will be starting with subtracting the per unit cost of direct materials and direct labor from the per unit selling price. So let's have a look above. We know that our expected unit selling price is 82. So we just need to subtract our direct material per unit of 20 and direct labor per unit of 36 from our selling price per unit of 82. Let's do that. That is going to be 82 minus 20, which is the direct material per unit, minus 36, which is the direct labor per unit. And since these three values are per unit and we are told to figure out the total budgeted profit, we just need to multiply this with our total production level. So let's have a look above. We were told that the budgeted output and sales in units would be 4,000, which is our total production level. So let's multiply it with 4,000. And then the next step would be to subtract all of our budgeted overheads. And we know that budgeted overheads are not per unit, but it rather reflects the total overheads for the month of August. And we're given the budgeted fixed overheads right here, which is 42,000. So let's subtract this. That is 42,000. Alright, so this gives our total budgeted profit to be 82 minus 20 minus 36 times 4,000. Minus 42,000, which results in the profit for the month of August to be 62,000. This concludes the first part of this question. Now we can move towards the second one. We are given additional information. Actual output and sales for August were 4,300 units. So our budgeted units were 4,000, but in reality, there were 4,300 units produced for the month of August. And the selling price per unit was 80, whereas our budgeted selling price was 82. Then we are given the actual cost for August as well. We are given the total direct materials cost, total direct labor cost, as well as the total fixed overhead. So now we need to figure out the actual profit. In order to do so, this is quite simple. We just have to find out our total selling price, which would be the selling price per unit times the total units produced, right? And then we would just need to subtract all of these costs or expenses in order to figure out the actual profit. Let's figure it out. So we will be starting with the actual sales. And we know that we sold 4,300 units. And we know that the selling price per unit was 80. So we just multiply it together. And this gives our actual sales for the month of August to be 4,300 times 80, which results in the value of 344,000. Okay, then we just subtract all of our expenses. So the first one is direct materials, which has a value of 95,718. Then we have our direct labor cost, and we can see that our total direct labor expenses was 150,500. And then we also need to subtract the fixed overheads. And we can see that our total fixed overheads was 43,600 for the month of August. We need to subtract this as well. Now we can easily figure out our actual profit. That would be the sum of these four units. So that's 344,000 minus 95,718 minus 150,500 minus 43,600, which results in our actual profit for the month of August to be 54,182. This concludes the second part of this question. Now we can move towards the third one. So we need to calculate the variances for the third part. And for the first one, we need to calculate the sales price variance. And we know that the formula for sales price variance is the budgeted selling price per unit minus the actual selling price per unit. And then we just multiply it with our actual units. And we are subtracting the actual selling price per unit from the budgeted selling price per unit, because we know that the budgeted selling price per unit was the greater one, right? So let's have a look above. It's given right here actually. The budgeted selling price was 82, whereas the actual selling price was 80. Let's substitute these values. So that's 82 minus 80, and we just need to multiply it with the actual units produced. So in this case, that's going to be 4,300 units. So this gives the sales price variance to be 82 minus 80 times 4,300, which results in the value of 8,600. Okay, so this just represents the value that we lost due to the fact that our actual selling price was too less than the budgeted selling price, right? So this is not a favorable condition, because clearly if our actual selling price was equal to that of budgeted selling price or even greater than the budgeted selling price, then that would get us a higher value for the sales, right? But since our actual selling price is less than the budgeted selling price, the total sales value, we are actually receiving it 8,600 lower, right? So this is not a favorable condition, which means that this would be an adverse condition. Okay, now we can move to the second one. We need to figure out the sales volume variance, and we will be using the standard profit margin per unit. So for this case, we know that the actual sales volume was of 4,300 units, whereas the budgeted sales unit was of 4,000. So clearly actual is higher than the budgeted in this case. So we will be putting our actual output and then subtracting the budgeted output from this. Okay, and we will be using the standard profit margin. So that would just be our budgeted profit per unit. Okay, we know that our actual output was of 4,300, right? Let's write it down. And we know that our budgeted output was of, I think it was 4,000. Yes, it was 4,000. Let's write it down as well. And we need to multiply it with our budgeted profit per unit. So we have already figured out our total budgeted profit. So if we require the budgeted profit per unit, we just have to divide it with the total number of units produced. So in this case, that's going to be 62,000, which is the total budgeted profit, divided by the output or the number of units. So that's 4,000 for our budgeted, right? So this gives our profit per unit to be 62,000 divided by 4,000, which is 15.5. So let's substitute this value into our variance. So that's 15.5. And this gives our sales volume variance to be 4,300 minus 4,000 times 15.5, which results in the value of 4,650. And we can see that our actual output is greater than the budgeted output, which means that there is a greater sales volume, right? Which is definitely a favorable condition. All right. Then we have our labor rate variance. So for labor rate variance, we just need to figure out the difference between the per unit labor rate for the budgeted as well as the actual. So let's figure out which was the greater one. So we're talking about labor, right? So let's figure out our per unit. That's going to be 150,500, which is the total direct labor cost, divided by the total number of direct labor hours. So that's 12,040 hours given right here. And this will give our direct labor per hour to be 150,500 divided by 12,040, which results in the value of 12.5. Okay, then let's have a look at our budgeted information. We can see that the direct labor rate per hour is given to be 12. So clearly the actual rate is higher than the budgeted. So we will be subtracting the budgeted rate from our actual rate. Let's write down the formula. So that's going to be actual labor rate per hour minus the budgeted labor rate per hour, and then we just have to multiply it with the actual total labor hours. So that's actual labor hours. So we figured out our actual labor rate per hour to be 12.5 and the budgeted labor rate per hour to be 12. And then we just need to multiply it with the actual total labor hours, which is 12,040. Let's write it down. So this gives our labor rate variance to be 12.5 minus 12 times 12,040, which results in the value of 6,020. And we can see that our actual labor rate is higher than the budgeted labor rate, right? Which means that this is actually an adverse condition. Because we're talking about an expense here, right? And higher the expense, the lower the profit. So the higher actual labor rate results in an adverse condition. Now we can move towards the fourth one. We have labor efficiency variance. And for labor efficiency variance, we just find the difference between the total labor hours and then multiply it with our budgeted rate per hour, right? So let's figure out whether the total labor hour was greater for the actual one or the budgeted one. So for our actual one, we know that our total labor hour was 12,040. Let's figure the same for our budgeted. So we know that the direct labor hours per unit required was 3 and the total units were 4,000. So in order to figure out the total direct labor hour, we can just multiply the hours per unit, which is 3, with our total unit of output. So that's 4,000, which gives our total direct labor hour to be 12,000. So clearly the total direct labor hour is higher for the actual one. So let's write down our formula. We will be subtracting the budgeted total hours from the actual one. So that's actual total direct labor hour minus the budgeted total direct labor hour and we just need to multiply it with the budgeted rate per hour. We know that the actual direct labor hour was 12,040, whereas the budgeted total direct labor hour was 12,000. Okay, let's have a look above for budgeted rate per hour. So we're given it right here. The budgeted rate per hour was actually 12. So let's multiply it. Now this gives our total labor efficiency variance to be 12,040 minus 12,000 times 12, which results in the value of 10,320. And we're talking about labor efficiency, right? So this means that the higher the direct labor hour, more favorable it is. And we can clearly see that our actual direct labor hour is definitely higher than the budgeted direct labor hour, which means that this results in a favorable condition. Now we can move towards the fifth one. We need to figure out our fixed overhead expenditure variance. So this will just be the difference between the budgeted fixed overhead and the actual fixed overhead. So we need to figure out which one is the higher one. Okay, we can see that our actual fixed overhead is 43,600, whereas our budgeted fixed overheads were given to be 42,000. So clearly the actual one is higher. So we will be subtracting the budgeted one from our actual one. So that's going to be actual fixed overhead minus the budgeted fixed overhead. And we had our actual fixed overhead to be 43,600, whereas the budgeted fixed overhead was 42,000. So this gives our fixed overhead expenditure variance to be 43,600 minus 42,000, which results in the value of 1,600. And we are talking about fixed overhead, right, which is an expense, which means that higher the expense, lower the profit. And in order to get a favorable condition, our actual fixed overhead should be less than the budgeted fixed overhead, which is not the case here, because clearly our actual fixed overhead is higher than the budgeted fixed overhead, which results in an adverse condition. Okay, now we can move towards our fixed overhead volume variance. And this is quite simple. This is just the difference of the units produced, the budgeted units and the actual units, and we multiply it with our budgeted fixed overhead per unit. So if you remember correctly, then the actual units produced was 4,300, whereas the budgeted was 4,000. So we will be subtracting the budgeted one from the actual one. So that's actual output minus the budgeted output. And we multiply it with the fixed overhead, budgeted fixed overhead. Per unit. Okay, so we know the actual output to be 4,300. We know the budgeted output to be 4,000. Now we just need to figure out our budgeted fixed overhead per unit. So let's have a look at our budgeted information. We know that our budgeted fixed overhead was 42,000. So in order to figure out the budgeted fixed overheads per unit, that's just going to be the total value of 42,000 divided by the number of units. So that's 4,000. Which results in the budgeted fixed overhead per unit to be 42,000 by 4,000, which results in the value of 10.5. Let's substitute this into our variance. So that's 10.5. And this gives our fixed overhead volume variance to be 4,300 minus 4,000 times 10.5, which results in the value of 3,150. And we are talking about the volume, right? Which means that in order to receive a favorable condition, we require the actual output to be greater than the budgeted output, which is the case in this particular question. So this obviously results in a favorable condition. All right. So this actually concludes the third part of this question. Now we can move towards the fourth one. Okay, we're given additional information. Material price variance and material uses variance have been calculated at 4,558 adverse condition and 5,160 adverse condition. Now for the fourth part of this question, we need to prepare a statement reconciling the budgeted profit at 4,000 units level with the actual profit. And we will be starting the statement with the budgeted profit in part A. All right. So we actually require 3 columns. The first one would be to record for all of our favorable conditions. The second one would be to record for all of our adverse conditions. And the third one would be the total. And we were told to start from the budgeted profit. Let's have a look at our part A. We figured the budgeted profit to be 62,000. So let's substitute this value. And we are reconciling the budgeted profit to the actual profit, right? So we will be adjusting 4 factors. So the first one is sales, and for sales we need to adjust the price variance as well as the volume variance. Then the second one will be material. Again, we need to adjust the price variance and the uses variance. Then for labor, that would be our rate variance and the efficiency variance. And for fixed overheads, that would be the expenditure variance and the volume variance. So let's first list down all of the items to be recorded in this statement. So we will be starting with our sales factors. So that's sales price variance and sales volume variance. So let's have a look above, because we already figured out both of these in our third part. We can see that sales price variance is 8,600 adverse condition, meaning that we will be recording this value in our adverse condition column. And we have our sales volume variance of 4,650, and this is a favorable condition. So we will be recording this value in our favorable condition column. Let's do that. So we first had the sales price variance of 8,600 adverse condition. So that will be in our adverse column. Then we had the sales volume variance with favorable condition with the value of 4,650. Okay, now we can move towards our material. So that will be material price variance and material uses variance. So regarding the material, we were given in our additional information, the material price variance is 4,558 adverse. Let's write it down. And the material uses variance was 5,160, which is adverse again. Okay, now we can move towards our labor factors. So that would be labor rate variance and labor efficiency variance. We figured both of these in the third part of this question, so let's have a look above. We can see that our labor rate variance is 6,020 adverse condition and our labor efficiency variance is 10,320 favorable condition. So let's record these two values in our statement. Firstly, we had our labor rate variance of 6,020 adverse condition. Then we had the labor efficiency variance 10,320 favorable condition. Okay, then we have our final factor, which is a fixed overhead. So we can just term it as overhead. First one is overheads expenditure variance. And the second one is overheads volume variance. Let's have a look above. We figured both these in our third part. So we have fixed overhead expenditure variance of 1,600 adverse condition and fixed overhead volume variance of 3,150 favorable condition. Let's record both of these. So we had our overheads expenditure variance of 1,600 adverse condition and the overheads volume variance of 3,150 favorable condition. Okay, now we can figure out the total for both the favorable conditions as well as the adverse conditions. For favorable one, it will be the sum of these three values. So that's 4,650 plus 10,320 plus 3,150, which results in the value of 18,120. Then for adverse one, that would be the sum of these five values. So that's 8,600 plus 4,558 plus 5,160 plus 6,020 plus 1,600. So that results in the total of 25,938. Now we need to adjust these favorable values and the adverse values to our budgeted profit. And this is pretty obvious. So we will add the favorable values whereas subtract the adverse values. So let's record it in a bracket indicating that this needs to be subtracted. And now this will give our actual profit. So we need to just adjust these two total values to our budgeted profit. So that's going to be 62,000 plus 18,120 minus 25,938, which gives our actual profit to be 54,182. Let's have a look above to check if this was the actual profit that we figured out in our second part. And we can see that indeed the actual profit is 54,182, which means that our reconciliation statement is correct. And this also concludes the fourth part of this question. Now we can move towards the fifth one. We are given additional information. After analyzing the direct materials variance, the directors of Tea Limited plan to purchase raw materials from a new supplier who provides better quality raw materials, but at a higher price and with no trade discount. We need to advise the directors whether or not Tea Limited should change to the new supplier, and we also need to justify our answer. First of all, let's have a look at our materials variance. We can see that both the price variance and the uses variance were in an adverse condition, right? So let's write it down. We can say that adverse materials price variance suggests higher price than the expected one. Adverse materials price variance suggests higher price than expected. And we also had adverse materials uses variance, right? And it suggests poor quality leading to wastage. Let's write it down. Then we're also told that there will be no trade discount from a new supplier, which means that this will make the materials more expensive. Let's write it down. And we are also told that the new supplier provides better quality raw materials, which means that maybe that will reduce our wastage. Let's write it down. Better quality from new supplier can reduce wastage. Okay. And since we're talking about a new supplier, we do not know whether the supply of raw materials from new supplier will be reliable or not. That would be a question as well. Let's write it down. Supply of raw material from new supplier is it reliable? Alright, so based on these 5 factors now, we need to make a decision advising whether the directors should change to the new supplier. So we know that previously we had both adverse materials price as well as adverse materials uses. And since we're getting no trade discount from the new supplier, this doesn't ensure any lower price, but we are assured that there would be a better quality, which means that it will definitely reduce our wastage, which can change our materials uses variance to a favorable condition, right? So based on that particular factor, I would decide to advise the directors to change to the new supplier. Let's write it down. The directors of Tea Limited should change to a new supplier. Alright, this concludes the 5th part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.